We have Karan Taurani, Senior Vice President from Elara Securities, joining us to discuss on why Zomato might be raising this fund. So, Karan, first question to you: why, according to you, the company is looking to raise funds? They have around more than 10,000 crore of cash already on books. Why this fundraise?
Hi, morning. So I think in terms of the reason for this fundraise is very clear. One is I think they want to take advantage of the situation. Investors really want to invest in these high growth internet names. There is a lot of interest here. Swiggy IPO is around the corner, so I think they would want to make the best of this opportunity. Second thing is this is like a what just kind of a cash which can be used in the future because the e-commerce market is kind of seeing the pinch of quick commerce, and that is why e-commerce players are also venturing into the quick commerce market. Names like Amazon, Flipkart are also wanting to come into this space, and some have already tested waters in some cities. So the market opportunity is quite huge here in terms of expansion, in terms of scale. It could take everyone to a surprise in terms of what the kind of scale quick commerce market could reach, over the medium to long term from a perspective. So I think they want to be kind of well prepared for that situation as well. The third thing is that, of course, they want to have a bigger cash pile versus competition. That's what we believe. Clearly, if you look at Zepto's recent rounds of fundraise, they would be at close to more than $1 billion. Swiggy, has got about 6,000 crores, and with the latest fresh infusion from the IPO, they would also breach, the 1.2, $1.3 billion mark, and that's where Zomato is today potentially. So, given the kind of market leadership situation that they have, both in the food segment and the quick commerce segment, I think if they're able to raise more money, and they're bound to have more cash versus competitors because of their size and scale. Potentially because we don't know in terms of which way the market is heading, whether it is heading to discounting, whether it is heading to increase competitive intensity, what are the kind of investments that we need in terms of technology expansion, everything put together. So I don't think this is the kind of investments that needed. So I think 10,000 crores per share is good enough, for Zomato to have in terms of cash pile. But this is just a preparation, for the future, and also kind of being a notch above the competition as far as the total cash component is concerned.
Okay, point taken. But Karan, then are you saying it's a bit more, psychological warfare which is at play when it comes to this quick commerce space? You're saying it's to make sure that the balance sheet is the strongest and have the highest cash on books. But wouldn't that impact the return ratios quite a bit if you have idle cash sitting on books?
Yes, I think it will impact return ratios over the near-term perspective. Definitely some negative impact of that. Negative impact of valuation also could play, basis that. But I think from medium to long-term perspective, I think they have to be prepared for the quick commerce race, right? Because it is going to become quite highly competitive, the entire segment. We already have about 3 to 4 players, and in this segment, clearly, what you have to see that all the other players are large conglomerates. So there are no fringe players who are who may come to sell out stake and who may want to exit the market, like in the case of food tech business, wherein Zomato, Swiggy both acquired multiple companies like Uber Eats and everything put together. So I think it's a very different kind of market altogether. This market is eating up share from the modern trade, from the kirana stores, and also from e-commerce, right, the quick commerce space. So I think it makes logical sense to kind of be well prepared and see in terms of how things shape up. But I don't see any inorganic opportunity as such, for now in terms of the quick commerce market.
But Karan, the Swiggy IPO is just around the corner. Do you see that getting impacted in some way because of this?
Yeah, so I think there could be a mild negative impact on the kind of response Swiggy would get in terms of their infusion, or in terms of the oversubscription numbers. Because clearly, I think from an investor standpoint, in 2021 after the IPO, I mean 2020 was the pre-IPO phase, but after the IPO, they haven't had a chance to kind of look at Zomato and kind of really infuse capital in a very big manner. So this will allow investors to invest into a stock like Zomato, and I think there's a high likelihood that this will see a better response versus Swiggy, given the kind of track record and execution that we have seen from Zomato's management. And they will actually get a chance to kind of make the most of it and kind of stay invested in a company like Zomato, which has got superior track record, metrics, execution. I mean, we've all seen the numbers of Zomato versus Swiggy. So Zomato has been top notch, to put it that way. So I think there could be a mild negative impact on this in terms of potential oversubscription or potential interest or cash infusion for Swiggy IPO basis this infusion in Zomato.
Interesting, but Karan, just wanted to go back to the point that you were making earlier. Do you expect this to be only an enabling resolution, or you are expecting the fundraise to happen within the next 10-15 days itself?
I think we'll have to wait in terms of what the management has to say on that. But as we clearly see that there is no specific reason for the funds to be needed over the near term. So this may just be held as a resolution, and maybe in the coming weeks or month, basis the situation in terms of Swiggy IPO and the competitive intensity, they will try and assess in terms of what is to be done. Also, one last point I'd like to put here is that Swiggy, right, Blinkit, for example, the quick commerce segment, strategically the management has clearly laid out that the quick commerce business is not a discounting game for them. At least they will never kind of go dirty in terms of discounting, hefty discounting, and kind of impact their cash flows and profitability. So from an investor standpoint, at least to have that safety haven, that from priority perspective, Blinkit as a business model is choosing good user experience over discounts. So I think that's another safety point for the investors for now.
You have been tracking this industry, this sector quite closely. Just wanted to understand one thing from your side, that is there any player that could be a potential target or acquisition target for Zomato, because of which they might be looking to enable this board resolution of raising funds, and going forward they might look to acquire any company in the sector, any small, any big company?
So as I said, the food business is obviously consolidated. Both these companies have a market share of more than 90% odd. The quick commerce side, of course, it's quite fragmented, and it is bound to get more fragmented with the entrant of Amazon, Flipkart kind of players, and JioMart also kind of making inroads into this. But as I said, all these companies are large conglomerates. So at least in the quick commerce segment, I don't see an opportunity wherein they will probably would want to acquire, or any company would want to exit for that matter, because all these conglomerates want to take this e-commerce segment very seriously as of now. So as of now, there's no opportunity as such, and I don't even foresee anything beyond this, right? I mean, quick commerce has obviously been a growth engine. It's been a major focus area. So it's not that quick commerce growth rates are converging towards 20-30%, and quick commerce does not have potential to scale. So I don't even see the situation wherein they need to look for some other business segment, because quick commerce future is quite bright. And if quick commerce scales up beyond the metro cities, we could have these kind of growth rates of 50% and more over the next 8 to 10 years. So clearly, as of now, it doesn't seem to be the case wherein they have identified any kind of target or any kind of inorganic acquisition that they would plan to do in some other segment, because quick commerce itself, has got a very strong opportunity over the medium term.
Last question, Karan, before I let you go. There is that speculation that a reason, perhaps a potential reason of this fundraise could also be to skew the entire shareholding pattern a bit, because they want to reduce the FII holding as per some reports. I wanted to understand, is that a major overhang, or does that change the operations in any way? What could be the rationale for this, if at all?
No, I don't think there's any major overhang. So for companies like Zomato, specifically, if you see, the holdings have always been very scattered, right? So there's always overhang of some PE block coming in, some FI investor wanting to sell in. So if you have a higher domestic holding somewhere, you will probably have a more of a safety haven kind of a thing in terms of the holding structure which is there. But this does not impact the company in any manner in terms of operationally, in terms of functioning, or in terms of management.
Well, thank you, Karan, for joining us and for giving us all those details and for putting things into perspective.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.